how to shortlist banking stocks. Before we learn that, let me show you a small video and then we'll move forward.
Today, the banking industry is considered as the backbone of the economy and has a major contribution to its growth. It's also the main driver for currency and financial stability. But how did the story of banking start? The term bank is derived from the old Italian word, banca, meaning a bench. It referred to the public benches where money changers used to sit for exchanging coins or bills in the marketplace. But it's the goldsmiths of 17th century London who developed banking in its modern form. The goldsmith who used to store wealthy clients' gold in their private vaults soon began to lend this gold to others in exchange of a promissory note and the payment of an interest charge. That was the beginning of banking as we know it today. So, what is the general role of a bank? Depositors, or people with money surplus, place their money at the bank in order to earn a return through the credit interest. Borrowers, or people with a shortage of money on the other hand, are willing to pay interest on the money the bank is lending them in order to accomplish an objective they're seeking. And how do banks make profit? A bank's primary source of revenue comes from the difference between the interest it's paying to depositors and the one it's earning from borrowers. A bank also makes profit from charging fees or commissions for services granted by the bank to its customers and from investments. So, why are banks regulated? Banks collect funds from depositors in the form of small-sized deposits and repackage them into larger-sized loans. Borrowers, on the other hand, might not be able to repay the money they borrowed from the bank. In addition to that, banks sometimes invest deposits in risky assets. All of these reasons explain the major role of central banks in protecting depositors' money by monitoring the adequate level of riskiness the bank is taking. What is the role of central banks? Central banks oversee monetary policy to implement specific goals, such as currency stability, low inflation, and full employment. They determine the interest rates that influence the bank's pricing schemes and the economy's money supply. They issue currency and grant authorization to establish banks. Central banks also impose a threshold for capital requirements and place reserve requirements to ensure liquidity in crisis mode. They shape lending policies through margin requirements and other tools, and they act as a lender of last resort to finance banks that need liquidity. Today, several types of banks exist to answer the different needs of consumers and to give them a choice in the way they manage their money. A retail bank, for example, provides services to individuals. Commercial and corporate banks serve small to mid-sized businesses and large enterprises. Investment banks specialize in large and complex financial transactions. Private banks offer a personalized financial and banking service to high-net-worth individuals. So, what do we know today about the future of banking? Direct channels such as mobile and the internet are becoming increasingly important in retail banking as they are in our everyday's life. Customers today expect financial firms to listen, respond, and offer services through social media. Customers across all segments expect highly personalized, convenient, and reliable service, along with 24/7 accessibility. Banking is no longer somewhere you go, but something you do.
All right. I think fairly simple concept. It just gave you an overview of the banking history and where we are today, and role of central bank and how they are making money. So the simple way the bank makes money, the main core operation of the bank is they take money deposits from you and give you a certain percentage. Let's say in FD they give you 6%, and in savings account they give you 3%, and they use that money to give loans at a higher rate, 8, 9, 10%, whatever the rate is. And that difference which they have, that difference is what their business is. That's where they make money. Right? Broadly, that's what is happening now. Current account, savings account, and FDs is debt which the bank has taken from you. Understand this concept. When you're going and putting money in the current account or your savings account or your fixed deposit, think from the bank's perspective. I am the bank and I have got money from the depositors, from the customers. This is a debt for me. Loan liya hai maine. I've taken a loan which I have to return to them with interest. Yeah, in current account there's zero interest, so I have to return just the principal, but I have to return that amount whenever they demand or whenever the term says, right? So that's a debt for me, for a bank. Yeah. So debt is the raw material for the bank because they will use this debt to give loans to people and make higher income there so that they can make their profit. And that's the reason the debt to equity ratio is not valid for banking and financial services companies. Debt to equity ratio, what we looked at, it should be below 0.3 ideally, right? That's what we discovered in session number 3. But it is invalid in case of banking stocks. Why? Because banks are supposed to have high debt. So you don't look at debt to equity ratio in a banking stock. It's irrelevant. It's invalid to look at that, right? Let's run a query on Screener. Let me show you some with an example. Let's say I go to screens and I create a new screen and I put the query debt to equity ratio, sorry, D by E. Debt to equity is more than, let's say, 7, which is huge. We were looking at debt to equity less than 0.3. More than 7 is like, I mean, obviously I don't want such companies, but I'm okay with banking stocks to be like that. So let's run this. Let's arrange it by market cap. Look at this. Most of the time you will find banks: SDFC Bank, State Bank of India, Axis Bank, Adani Greens. Not a good sign. Adani Greens has got more than debt to equity ratio of 28.12. So that is like going above the roof. IndusInd Bank, Bank of Baroda, Punjab National Bank, IOB, Canara Bank, Tata Communication. Yeah, so again there's a problem. Power Fin Corporation, again the finance company. IRFC, again a finance company. Union Bank, IDFC First Bank, REC. So you look at the debt to equity ratio of banking stocks, it will be like 7, 8, 10, 12, 14, whatever it is, and that is fine to have because they are supposed to work like that. So you're not supposed to look at this particular ratio for the banking stock.